Good evening, everybody. We're sorry for the delay. The uploading was running into problems. So, anyways, we've got the great pleasure of having Kirt Christensen with us tonight. The reason I like having Kirt on is he developed his own successful trading system. So, with that system, he's got some very unique insights as far as how you consistently make money with some of his trading rules. So with that, we won't delay anymore. Kirt, good to have you here. We're anxious to see your information.
Hey, thanks for having me on, Stephen. And yeah, again, apologize for the slowness. That was my fault getting the PowerPoint, and then it converted slowly. So we're ready to roll now. So we're going to talk today about my ETF trading system called ETF Tipping Point, and exactly how you can use that to make other trading decisions on, and to use it by itself, to use it in conjunction with other things that you're already doing, because it's one of those things that I'm a big time disciple of swing trading. So we're looking for something that delivers big time returns in all kinds of market conditions, lots of compounding without being chained to your computer. And I'm going to skip through some of these slides because we got 150 slides and obviously not that much time. But this slide kind of boils down exactly what we're going to be talking about tonight. And this is obviously very current. It's current as of today. Today being 5/17/2018. It shows our exact positions. So if you get nothing else out of this presentation tonight, here's the exact positions that we have on in the ETF Tipping Point. We recently switched 4 days ago on 8 out of the 9 sectors. You can see that we're now bullish on everything except for gold, which is bearish. And this is pretty common in the early going of trades. We've only been on 4 days, so you've got some marginal winners, some marginal losers, and nothing's really happened yet. But it looks like we're on a bullish trend, and we're going to determine how exactly we come up with this, what sectors we cover, why we use ETFs, and kind of where we get all the data to make these decisions. Because this isn't some subjective methodology where I'm looking at charts, or I'm looking for any particular chart pattern or Fibonacci's or anything like that at all. So we'll go through and explain exactly what it is. So what's an ETF and why should I care? Well, probably if you're here with us today, you already know what an ETF is and why you should care. So we'll kind of skip through that. But basically an ETF is a fund that tracks like an index. And so it does it by not trying to beat the market, but by trying to market in that particular thing. So, for example, the Dow Jones, obviously the most well-known to the general public anyway, stock market average, it also trades as an ETF in the form of the DIA. So the ups and down movement of the Dow Jones Industrial Average are now captured in an easy-to-trade, concise little package. So why ETFs? Well, they allow you to massively diversify your portfolio with the simplicity of trading a single stock. If you, for some reason, think that uranium mining in Argentina is going to take off, there's probably an ETF for that. Now, I'm being a little facetious, but I can almost guarantee you there's some ETF that covers uranium mining, and there's probably some other ETFs I'm sure that cover Argentina. And ETFs are kind of the darling of the financial world right now. There's actually over $10 trillion that have flowed into ETFs. And there's actually over 6,500 different ETFs. So sometimes I get the question, because people know that I trade ETFs a lot in options. They ask me about some weird off-brand ETF name, and hey, there's 6,500 of them. I can't keep up. But obviously most of you are going to be familiar with at least the top 20 or maybe the top 50. So why should you listen to me? Pretty simply. I'm a normal, ordinary, average guy. I'm from a small dairy farming town in Preston, Idaho. If you ever saw the 2004 movie Napoleon Dynamite, well, that's set in my hometown. This is the ranch that I grew up on in Mink Creek, Idaho. So, I wasn't born with a silver spoon or anything like that. And I really have two main interests in life, and if anything like you, a gazillion side ones. So see if you can pick out what my interests are. Just flipping through some slides here. Yep, I like to travel, and I like to do stuff with my family and my kids. And so any methodology that I pick up or any investing goal that I have is based on these rules. Way above market returns, lots of compounding, less than 15 minutes a week. So here's the results if we use the ETF tipping point system goes all the way back to 2006. So if we went back to 2006 and put $10,000 into each of the 9 different ETFs that we track, that $90,000 would have turned into 24.5 million with compounding, 27,000% return on capital. Of course, you know, we would have to be there in the beginning, take every single trade as they came up. I'm not saying we did that, of course. But you know, even without compounding, $90,000 would have turned into nearly 600,000 with 0 compounding. So you know, we're making trades that kind of in this time frame. So this is a year. This is the daily chart of the Dow Jones showing a year of candles. You can see exactly where we went short and where we went long on the Dow, the S&P 500, the NASDAQ. Banking. Now, banking is a great one, the KBE, because it's more volatile. There's more trades on it. So anytime there's more trades and you have a system that has a positive expectation, on average, you're going to make more money. Obviously, if you know we're here in this time of year, if you follow basketball at all, you know it's all boiled down to the NBA. So if you have a guy that shoots 90% from the free throw line, you know, it doesn't matter if he missed the last five shots or if he had 5 losing trades. You're going to want that exact guy to take the very next trade because he still has an extremely high average. Oil is my favorite sector of all of them. We trade the OIH, which is the Oil Services ETF. You know, we've had hundreds of trades on oil going all the way back to 2006, like we mentioned, and we actually just completed our 3rd losing trade on oil in that entire time period. Gold has been a little bit harder for us lately because it just really hasn't done much. Semiconductors is another great one just because it trends like crazy over long periods of time. Real estate, a lot the same thing. And then materials, which is kind of a forgotten sector. This is, you know, building materials, basically, the things, the basic building blocks of the economy. So we keep track of all of this, and this is something that we have all the records for from every closed trade going back to 2006. And you know that's all available. This is supposed to be a video, but we uploaded it, so it doesn't exactly work like a video. So I'll skip that. But you know, we're not looking for home runs, but we do get the occasional, you know, solid triple or double depending on who you are. 41.82% gain, a little over half a year on the KBE. Oil, like I mentioned, is our most profitable sector. So here's some of our oil trades. The black arrows indicate when it's on the top, indicate we went short, and when on the bottom when we went long, going back several years. Well, let's talk about, well, how do we generate these signals? That's great that we have the signals and we have these different sectors, and we're going to talk a little bit later about why ETFs are so powerful, because not only are we talking about the ETF itself, but the ETF itself is a proxy for something else. It's a proxy for an entire sector of the economy. So just put on your trading caps. I mean, if you knew that the oil sector was bullish, well, I mean, what kind of different vehicles could you trade? Well, you could trade all kinds of, you know, not just that particular ETF. There's a gazillion ETFs in that sector that would all trade in lockstep, basically, with the overlying sector. Not to mention options, not to mention options on futures, not to mention futures and all those sorts of things. So here's where I'm going to get a little controversial. I'm going to say that technical analysis is 50 years of traders arguing about stuff that works sometimes. So, you know, if you go to Amazon and type in technical analysis, you're going to get 50,812 results for books related to the subject of technical analysis. My controversial statement for the evening is that moving averages suck. Larry Williams, you know, who I highly respect, you know, he's filled dozens with books with 60 or so different oscillators, but the answer, in my opinion, is that technical study by itself doesn't do it, because really everyone's looking at the same data. There's really only 3 elements that that we work with, and those are price, time, and volume. So kind of as a little bit of a foreshadowing of those 3 elements, what do you think are the one element out of those 3 that's the least understood and the least applied to current trading? Which of the 3, price, time, or volume, is the least used, the most misunderstood, the overlooked stepchild, so to speak? Yeah, it's volume. We have a couple people coming in with that. And that's absolutely true. So, you know, everyone scrambles to put their name on some proprietary indicator that attempts to manipulate those results in a slightly different fashion than the next guy. But the basic failure of all of those is they all use moving averages, whether they're called Bollinger Bands, MACDs, stochastics, parabolics, triple smooth exponentials, and all the rest. But anybody who's been around trading for any period of time knows that moving averages are a big time gotcha, because we set them too long, we miss all kinds of trades, and we don't get in at the right time. We set them too short, we get whipsawed to death, and we're going in and out of position every week, and losing money or break even at best. If we go to Investopedia, you're going to find there's no shortage of technical indicators. So it's not like this idea of coming up with a technical indicator is new. And actually, in Investopedia, if I remember correctly, there's over 1,000 different technical indicators. But most of them, the problem is, most of them rely on some form or usage of moving averages. So really, when it comes down to trading, and this is obviously something that everyone that's here and follows Stephen believes in as well, is the pack is invariably wrong. You got to have something that works, that's predictable, that's reliable, that you can count on, that not a lot of other people have. So here's how we actually do that. So first off, I really only am interested in things that have options on them. If it doesn't have options on them, I'm not interested, just because investor interest equates better trading vehicles. By that, the bid-ask spread is going to be a lot less. You're going to have a lot more volume, and you're going to have issues that actually count, things that move when the market moves. Number two is most ETFs are either price weighted or market cap weighted. And there are a few that are equal weighted, but in my opinion, the only way and sensible way to treat these is to treat them all as equally weighted. So S&P 500, we're going to reevaluate weight the S&P 500 so that every stock inside the S&P 500 has 1/500th weight, whether it's a $4 stock or a $400 stock. So we're looking for the movement across an entire sector. And so, like we mentioned, the sectors that we cover are everything from the S&P 500, the Dow, real estate, banking and finance, oil, gold. We're looking for these major sectors of the economy. So how this got started, I ran across a book, New Key to Stock Market Profits, came out in 1963. So it's actually kind of crazy that a 1963 book that I read has actually changed my financial life. I've been doing this ETF tipping point for no short period of time, since 2011. And 2011 to the public, we originally created the signals going all the way back to 2006, but finally in 2011, I finally got on board and decided to start selling it to a few people. And this New Key to Stock Market Profits is pretty simple. His idea, and he came up with this all on his own, independent of anything else, is he created an indicator called on balance volume. Now, the creator of this is actually somewhat infamous. His name is Joe Granville, and you may have heard stories about him. He's one of those traders out of the Wild West, so to speak, of the 50s, 60s, and 70s. And I think he was actually still around and doing some other things, even actually into the early 80s. He's the one who developed this concept of on-balance volume. And on-balance volume is very simple. The concept behind it is a change in volume is going to precede a change in price. And so remember, we just have price, time, and volume. So OBV, the simple calculation, is simply it adds a period's volume when it closes up and subtracts the period's volume when it closes down. That's it. A cumulative total of the volume additions and subtractions forms the OBV line. Then, of course, this can be compared with the price chart of the underlying security to look for divergences or confirmation. And of course, we don't need to go through the calculations, but this is probably one of the most important slides in the whole thing. So remember, we talked about what year did Joe Granville come up with this OBV? Well, 1963. And this chart, we're showing what's been the change in computing power since 1963. So if he came up with a concept that worked when they did the calculation manually at the end of each day, and that's it, imagine the possibilities today. Okay, so the difference in the possibilities is that the kernel of the idea, the OBV, is what we've taken and brought it into the computer age. If you look on that chart, in 1963, they were still using transistors, and personal PCs were still 20 years off. So it's almost unfathomable, the difference in computing power between back then and now. So what we do is we calculate this ETF tipping point by looking at every single stock that makes up the list of the ETF. So it means for the S&P 500, we keep a running total throughout the day as to whether there's more buying than selling going on each individual stock, on each transaction that makes up an entire ETF like the S&P 500. Every single trade, tick by tick. So quick question, how do you think you'd be able to tell if there's more buying pressure or selling pressure on an individual stock? Now remember, we're talking about volume, we're talking about that, but we're also trying to figure out how we calculate whether there's more buying pressure or selling pressure. Well, quite simply, is we evaluate the bid and the ask price. So the bid price, as you're well aware, is the price a buyer is willing to pay for a stock. The ask is a price a seller is willing to sell their shares at, and the spread is the difference between the two, the bid, spread. So what we do is we look at whether the trade went off closer to the bid price or closer to the ask price. And by doing that calculation on every single transaction as it processes throughout the day, it gives us a much greater confidence. Granville did his calculation at the end of every day. We do this calculation, multiple thousands of times a day on every single stock that makes up the ETF. And then we accumulate that over the prior 13 days, and we know with a pretty good confidence whether that entire sector is going to be bullish or bearish for the next week. So this is all done without any moving averages or any commonly available technical indicator. This is the entirety of how we make our decisions. Non-subjective, entirely rules-based, entirely mechanically driven. So let's kind of walk through the process. At this point, I'm going to assume that you've decided to forego your own tick-by-tick collection platform and might be interested in using our signals. Of course, if not, feel free. It took us multiple years to get this right. Ongoing data costs of over $1,000 a month, and this actually number is outdated. I've now spent over $250,000 in programming fees over the years, but some folks just do like to do it from themselves. For me, this has kind of been my baby since the get-go. So what we do is we send out a signals notification after 12:30 p.m. Pacific or 3:30 p.m. Eastern on Fridays. You can trade the next day the market opens, Monday, if you can't see or trade during the day. So we're buying or shorting the 1x ETF, or buying the 2x ETF or the 2x inverse ETF, or we're buying calls or puts on the 1-time ETF or the 1x ETF and buying calls or puts on the 2x ETF. So this is the current sample of exactly where we're at as of today. So 4 days ago, we entered into this market. Let's just use our best performing current trade that you look on there right in the middle, OIH. So 4 days ago on 5/14, it was signaled that we should go from bearish on that sector to bullish. So if we go from bearish to bullish, if you want to trade the single ETF, you can simply buy long, long the OIH. Of course, the problem with trading single ETFs is if you want to go short, you have to have a different setup of account than retirement accounts and things like that. Not that it's a big deal, but so we also provide the 2x ETFs. And so with the 2x ETF, one of them is long 2x, one of them is short 2x. So all we do on the OIH sector is we switch those funds back and forth between DIG and DUG. Those are the names of those two particular ETFs. So 4 days ago, we switched into DIG. And you can see we track all of these indexes, profit and losses on the basis of the single ETF. So on the basis of the single ETF, we're currently up 4.36% on the OIH. Now, of course, I bought the 2x ETF, so it's going to be not exactly 2x, but somewhere in the neighborhood of 6-7% up right now. Or, of course, we could have bought an option on the ETF. In this particular case, we would have bought an XOP option. The call is represented there, shows a September call at the 42 strike price. Or if we want to get really wild and crazy, which I don't recommend, but some people do, they buy the DIG option, call option on the DIG at the 45 strike price. So this simple format is what we use to divulge and disseminate the entire thing. Now, there's tons and tons of cool stuff that you can do based on this sort of thing. One of the things that I do, I'm more of an options guy than anything, is that I trade the CL, which is the crude oil futures. Now, crude oil futures, you said, well, Kurt, you just said you're an options guy. Well, I trade the options on the crude oil futures. And there is some crazy, amazing, awesome stuff you can do because the premiums are so rich on those crude oil futures that now, based on my underlying concept that I know, at least for the swing trade short term, that oil is bullish. Well, of course, I can make trades based on the futures options based on that. Not to mention, of course, trade by the dig, by the OIH, by an XOP option. Obviously the possibilities are endless. So, and then we just hold those positions until we receive a signal to reverse, or rarely we go to cash. That's like we go to cash like once every 2 or 3 years. We re-enter the trade on the Friday of the next week. So this ETF is either bullish or bearish in this system at all times. We try to be in the market at all times. Of course, some people are only comfortable playing to the upside. Then they trade when bullish and go to cash for that ETF when they're bearish. So really, that's a kind of a fast explanation for something that's cost me over $150,000 and a lot of time and hair pulling to get exactly right. But really, at that point, then we just do it again a couple hundred more times. So we've done this actually 624 total trades in the past 10 years for an average of only about 5.2 trades a month. So this is not a day trading system. This is not a fast action type of system at all. But it's this is I put a lot of my slower money in this. I put a lot of things that I'd like to see grow at a reasonably appreciable rate, and that still at a pretty reasonable or moderate risk. And then I just keep doing it and just keep compounding. Like we mentioned, we do provide the options, and we do provide some instruction on how not to over leverage yourself with options, because that seems like the most common questions I get with options are typically someone's over leveraged themselves, just straight out buying calls and puts. Let's see. So like we mentioned, who might be interested? Let me kind of just go through what the simple offer is, and then we'll open up for questions. And we have some kind of built-in question and answers that we typically get. And go ahead and type your questions in. So these are the type of trades we're looking at. Like last year on the Dow, looks like this was the 2016 for the Dow. Took in like let's see, total of 5 trades on the Dow. But this is what those kind of slow, methodical results over time can turn into. So going back to 2006, we would put it in 10,000 into every single Dow trade, followed it, monitored it exactly as specified. We've turned that $10,000 into nearly 450,000. S&P is a lot the same, nearly 10,000 into 470. NASDAQ, slightly better than that, 10,000 to 1.1 million. Banking, 10,000 into 3.5 million. And oil, now I mentioned oil is my favorite sector. Why do you think that is? Well, oil, you would have turned $10,000 into a little north of 12 million in that period of time. That's with 100% compounding. The profits are still on the table, put into the next trade, profits or losses, and rolled forward. Gold, not quite as good, 470,000. Semiconductors, a little over 3 million. Real estate, a little over 1 million. And materials, 1.6. And we're trying to we show exactly the trades. We show all the historical trades going back to 2006, and then we show current trades, and of course the recent current trades and the actual current trades are when. So this is kind of a funny thing we throw in here. What is this? Well, this is a hill of beans. That's what it amounts to if you don't take action. Like I mentioned, I never worked on Wall Street, did not have an MBA from Wharton or anything like that, but I have developed something that's worked very, very well for myself and for my customers over the last 8 or 9 years now. So my offer to coach 25 of you, there is 2 program options. You can pay $997 for 6 months access, or $2,997 for 3 years access. Like I mentioned, I hate overhead. We could get some fancy marketing guys, hire some full-time sales guys. But if you're in the neighborhood, feel free to stop by. There's our Trading Science office, name on the sign out front. The other half is an advertising agency of all things. And feel free to stop by. Spokane is in the eastern part of the state of Washington, and we're just right on the Idaho border. We've been around. We're going to be around. We're here for the long term. So, like I mentioned, I'm willing to put my money where my mouth is on this, take the majority of the risk, giving you an ironclad 2-part performance guarantee. It's pretty simple. You go through the entire trading, start trading live or in demo mode. If you don't love it, get a complete refund anytime within 90 days of ordering. Simply submit your trading log. Now, remember, the trading log doesn't have to be real trades. They can be demo mode as well. Issue a prompt refund. Or part 2, learn the system, use it for a full 6 months, executing all the trades as they come up. If you don't at least make back the system investment in profit, I'll personally work with you for free and tell you that you do. So either way, you love it and you make good money with it, or you hate it and you get your money back. I don't think we can be much more fair than that. We do have a couple bonuses for the first 25 people to sign up. We are going to make a donation in your name to kiva.org. If you're not familiar with Kiva, highly recommend you get over there and check it out. So an organization that provides microfinance loans to entrepreneurs in third world countries. So it's just a fabulous way to give back and give directly to entrepreneurs in third world countries who are running these small, profitable, cool businesses that help them put food on the table. We're also going to have a 2-day live workshop here in Spokane, Washington, in the fall of 2018. You get 2 tickets to that. So to claim one of the spots, easiest way, and we'll in the email later that comes out, we'll have the links as well. But you can either call our secure voice line at 509-720-7867, leave a detailed message with full name and address, phone and email, or you can go online to etftippingpoint.com/6-month or etftippingpoint.com/3-year. Yep, and those, oh good, Becky loaded the links in the bottom there. Perfect. So this is just a little bit of a recap of what we've offered. Talked about the spots. Talked about this is exactly what the system does. So we had a couple questions. So you haven't told us much about your system. Well, that's what the system is. The system is we analyze every single transaction. So for example, in S&P 500, 500 stocks that make up the S&P 500. We have the data stream of every single trade that happens in those stocks, tick by tick, and we analyze each trade as it goes across, whether it was closer to the bid price or closer to the ask price. As we accumulate those throughout the day and accumulate those over a period of a number of weeks, we have a good idea of whether there's more buying pressure or whether more selling pressure. Sometimes it diverges from the price. It's kind of like sometimes when you look in a stream, you can't tell how deep it is and how strong the current is when it appears very calm on the surface. Other times, when something's you look down in a river and it's super turbulent and looks like it's crazy rapid, but it's only a couple inches deep, so you can walk through it no problem. That's what this system is. The ETF tipping weight is looking for those underlying currents of what's happening. So kind of even a little bit more proof. Let's go into some FAQs. If you have some questions as we go through the FAQs, go ahead and type them in the chat box. So sometimes we have people ask, what about Brexit, flash crash of 2010, recession of 2008, win rate, drawdown, and profit per month? So I'll answer the second question first. The win rate and the drawdown and profit per month is all on the website as well, and we can provide those for you as well. In general, the average win rate by sector is averaged out at about 85% win rate by sector. The best win rate we have is over 95% on oil. The worst win rate, if I'm just picking off the top of my head, is probably the Qs. It's probably the worst win rate. Brexit, flash crash of 2010, recession of 2008. Well, let me pull that up. Well, in 2008, when everybody else sold off and was having, not sold off, but everybody took those massive losses, we went short on 6/13/2008, and we went long again on 12/26, 56.2% in that time when everybody else is losing their minds. The flash crash, if anybody was around back in May 6th of 2010, we were actually short that day, and flash crash didn't turn out to be anything major anyway, but we made 11% on that trade. We were on the right side of the trade. Exactly the same thing happened during Brexit. People were freaking out. Our system was already short. So even if it would have happened, that again turned out to be kind of a non-issue, but we would have been on the correct side of the trade. FAQ, what kind of experience I need to start? Well, really, if you're here with Stephen Bigelow, I'm sure you probably already know the basics. You really just need a desire to learn basic trading account software and commitment to make the trades. Can you trade in an IRA or 401k? Yes, you can. I do a lot of my kids' education IRA type of stuff based on this. I do some of my own personal Roth type of IRA type of stuff as well. How much starter capital do you need? I recommend at least $500 per sector or $4,500 to trade all 9. With less capital than that, you should just trade fewer sectors to build up your capital. The reason for that is pretty obvious, because you still have to pay commissions. So if you only have $500 and you're paying a $5 commission to go into a trade and a $5 commission to come out of the trade, that's 1% to get in, 1% to get out. If you have a trade that only made 4%, well, you just paid half of that in commissions. So at least $500 per sector, $4,500 preferably. Now, what's this question for? Well, of course, why aren't you retired on a tropical island somewhere? Why are you selling the system bus? This is the question we get all the time in trading education. Well, it's pretty simple. This isn't, we're never going to be able to move the market. The sectors that we're dealing with are, massive. The S&P 500, the Qs, the oil sector. So even if I had 1,000 students, and they all had, well, I do have about 1,000 students, but they don't all have $100,000 invested in the SPY, for example. If you calculate that out, even if I had 1,000 students who put $100,000 at one time into the SPY, that's about 500,000 shares. That would be 1/2 of 1% of the total shares traded that day. And we're even close to that. So the other secondary reason for that, is there any faster way for me to grow in my own trading account than to make frequent deposits to further the compounding? This is something that I believe in. I trade this every single day in my own account. So I'm looking to add money to my own account to be able to further profit from it. So there's someone saying that the link isn't working. It should work. Try that again. StephenBigelow.com/refer/ETFTP-6 month. How many versions, how many updates have we gone through on the system? We're currently on version 4. So, this is something we keep ongoing research and development in, and this is something that we continue to develop and work on intensely every day. Let's see. Go out for money back guarantee. We already talked about that. So I've got a little bit of time for some questions. Looks like we're about 12 minutes until the top of the hour. Becky just posted a referral link on there for the 6 month. I'm going to go back and check on some of the questions, see if I can answer a few of those. From Lee H, he says, is the system automated? The system, no, it's not an auto trading system. You do have to check for the changes. The changes only come out once a week on Fridays. And typically those emails come out at 12:30 p.m. Pacific, so 30 minutes before market close. Most weeks, of course, there's no change. But on average, there is about 5 trades or so a month. Let's see. Don P says, how many trades per month average for OIH? Well, on a yearly basis in the OIH, you're looking at around 7 to 8 trades in a year on the OIH. On KB, he says, other than coaching, what exactly would we be buying? Well, we have ongoing access to our monthly customer support, where we talk about exactly some other ways to use the system. Obviously the simplest way is just to use it either to trade the single ETFs or the double ETFs. But of course, people will say, well, what about, we have a number of people do things like, okay, well, based on your oil signal, what else could I trade based on oil? So we talk about options, we talk about option structures, we talk about spreads and all sorts of things. Let's see. We had somebody ask, I can't see it now, but there's somebody asked about what kind of options are we buying. The ones that we present here are deep in the money options, typically about 7 to 8 months out, with a delta of about 70. All right. Well, thanks everyone. We've got some great questions in there. I think we're ready to turn it back over to Stephen.
All right, very good, Kurt. Good stuff. everybody, again, this is a system that he has put together and has perfected it, so he knows all the ins and outs. So this is something that it's not theoretical. It's not the average, I want to say, things that everybody's looking at. He's got it pinpointed to where he knows exactly what his parameters are for getting in and out of a trade. So take a look at it. Again, he's got a guarantee that you either like it. If you don't, you come back out of it. So I would definitely recommend looking at Kirt's information. So with that, Kirt, thank you again. Good stuff. We'll see everybody bright and early in the chat rooms tomorrow. We'll see you then.